So you've got a pile of cash in your pocket and it's burning a hole.
I love gold!
Hey, Scrooge McStacker here, and today we've got a beginner's video on what to do when you've got a bunch of cash and you're thinking about maybe buying some metal. Today I want to talk about the concept of dollar cost averaging and why it's so important. Let's say that you've got your wad of cash and you really want to go down to the local coin shop and buy some gold. Should you do that? Is that a good idea? Well, it depends on a lot of details. Let's say you run down to the local coin shop, you throw your cash on the table, and they give you half an ounce. Maybe that was a good purchase. Maybe it wasn't a good purchase. The issue is time. The issue is what were prices previously, what are prices today, and what are prices going to be in the future. Contrary to what many optimistic stackers might like you to believe, the price of gold and silver, for that matter, is not a straight line up and to the right. It doesn't always go up. It goes up and it goes down, and that's especially true over short periods of time. Maybe this half an ounce here was a good purchase, but let's say that you were to wait a month, roll into that same LCS with the same cash, and then you come out with a full ounce. Obviously, that's preferable. But how did you know? How could anybody know? Well, the truth is you can't. You can't know what the price is going to do. You might have some guesses, and sometimes those guesses will be correct, and sometimes they'll be incorrect. Even the people, whether we're talking about gold or silver or the stock market or real estate, there are people who spend every waking moment researching these industries, and even they fail all the time to figure out what the price action is going to look like. And my guess is, for you and me, we don't want to spend every waking moment worrying about the macro and microeconomics behind the price of an ounce of gold. So what can we do? How can we stack effectively without necessarily being so tuned into the market? This is a question of risk mitigation or risk management, and that's where dollar cost averaging becomes useful. What we need to recognize is that when you take, let's say, some cash and you have a breakdown of that cash into equal amounts, imagine that you were to spend that cash over time, or consider all the times that you might choose to spend the cash. We should consider that there will be times where the price of gold is high in that period, and there is times when the price will be low. If we start with the understanding that we aren't going to guess the peaks and the troughs, we're not going to necessarily know when it bottoms out or when it spikes and peaks at the top, what's the best that we can hope to do? Well, the best that we can hope to do is buy it at the lowest and the highest and possibly halfway in between, so that when we average everything out, we get the middle ground. And that's important to remember. What we're searching for is the middle ground. We don't want to make the purchase of metals our job, so we're not trying to get all of the lowest prices. We're just trying not to get stuck with the highest prices. So let's say that we take this little bundle of cash here and we split it up across 4 transactions. So instead of 1 transaction, we're choosing 4. Now, how you break up your purchase is based on largely how much money you're spending. As many of you know, the smaller, since this is a beginner video, maybe some of you don't, but the smaller the denomination of gold that you purchase, the higher the premium, meaning the more money you spend on the overhead of the coin shop and the less that you spend on the metal itself. So perhaps for this quarter ounce of gold, you might end up wasting, in my opinion, 25% of your money on the privilege to buy it. Whereas this full ounce of gold right here, you're only going to lose maybe somewhere between 5 to 10%, depending on how bad the premiums are. But you're spending way more money on the gold and less on keeping the local coin shop operational. Whereas this one here, the quarter ounce, you're going to spend a lot more just on the privilege to buy it. I point that out because if you can reasonably save up enough money to purchase 1 ounce at a time, that's going to be much better for you long term. But let's remove the denominations for right now, and let's just focus on splitting up the cash. Let's say you go in month one. Again, it could be days, it could be weeks, it could be months, it could be years. But the point is equal timing. You want an equal spread of money and time. And let's say it's per month. You go in on month one, drop down a quarter of your cash, and you end up with 1/2 ounce of gold. Maybe a good purchase, maybe not. We don't know yet. That's just one data point, right? Well, then you go in month two and you end up with just this little quarter ounce. So first a 1/2 ounce, then a quarter ounce. Well, that either means that your purchase on month one was good, or it just means your purchase on month two was bad. Once again, there's only a couple data points here. We don't really know. Then we go in on month three and we end up with an entire ounce. Well, that feels like a great purchase. And right then, when you hit that point, now obviously I'm greatly exaggerating the difference in price here. In reality, we would probably be purchasing an ounce over and over and over again, and the price of that ounce would just be plus or minus $50 or $100. But I want to exaggerate it to make the point. By the time you get to this third purchase and you walk away with a full ounce, you might be kicking yourself and thinking, oh, why didn't I wait? Well, remember, there was no guarantee that it would ever happen. It's possible that we could have gotten to this same point, and instead of getting 1 full ounce, we go from a quarter ounce down to 1/10 of an ounce. And that's so little gold that I don't even have 1/10 of an ounce coin to show you here. But that's the part about predicting the future versus looking back at the past. You have to remember what you didn't know at the time and how badly things could have gone. So we got lucky that the price dropped so much that we went way up in the amount of metal on month three, but it could have gone the other direction and we could have ended up with less than a quarter ounce. We could have gone a 1/2 ounce to a quarter ounce to 1/10. And then what would you be saying? You'd be saying, oh, I wish I had put all my money in on month one. That's how easy the entire situation becomes inverted. And this is the purpose of dollar cost averaging. You don't know if the price is going to go way up or way down or stay the same. So you split your cash across an equal period of time and you buy whatever price is available. Then at the end, you will know two things. You got the worst price and you got the best price and you got whatever was in between. And that's generally the best you can do. Again, if you spend every day researching this stuff and you're keeping track of mining volume and mining infrastructure prices and inflation rates for multiple major nations and federal or central bank activity in major nations like both the US and China, if you track all of that, then maybe you can predict one of the better prices versus the worst prices. But even the people who try to do that every day, they get it wrong all the time. So this here is a common investment strategy. And by the way, it's not limited to gold and silver or metals or commodities. This is also how many people get into the stock market. They take a portion of their paycheck every month and they drop it into the stock market so that they dollar cost average across the price of all the different stocks. And in fact, there's another way to average out in the stock market. And I know obviously many of you aren't as much into stocks as you are into metals. That's cool. I just want to make sure that those beginners out there understand that this is not just about metals. This is about investing when you don't have adequate knowledge or up-to-date knowledge of the markets. Not only do people dollar cost average into the stock market, but they often purchase what are called index funds. And those index funds essentially take an average of all the different companies in the stock market. Now, they have different rules for how they select the average, but they essentially take a pool of different companies and they buy different amounts of different companies so that you are averaged out not only in when you purchase the stocks, but which stocks you purchase. This is an example of averaging, specifically dollar cost averaging into metal. This is how I stack. Every month, I try to go out and buy another ounce of gold, whatever the price may be. Now, I might occasionally wait a few days or a week on either end if I think some exceptional event has occurred. But every month, I try to go ahead and pick up another ounce of gold at whatever that price may be. And this channel is largely dedicated to every month or thereabout buying new metal, showing you what's in my savings account. And today I just wanted to educate you about why I buy the way that I buy. It's the way that many other stackers and investors also buy, and I wanted you to understand why. So again, when you dollar cost average, you are going to purchase the worst prices right here, like this quarter ounce, but you're also going to purchase the best prices. That's the power of dollar cost averaging. So if you enjoy this educational material and if you enjoy keeping up with the stack, please do hit that like button and that subscribe button. I'm Scrooge McStacker. Keep on stacking.